All right, how's it going, everyone? My name is Amos. Welcome back to the Dividend Compounders with Cheese channel. By the way, if you can't tell, this is going to be a different vibe. I think this video, we're going to keep it chill. We're going to keep it calm. Hope you're having a good day, by the way. Here in Japan, it's pretty chill. I mean, it's cloudy, kind of cold. I feel like snow is going to come around the corner. Feels pretty good. Holiday season is always the best, right? Anyways, the other day up on the YouTube channel, I made a post talking about like, hey, what's the next stock that I should analyze on the channel? And we got a lot of different comments, right? Out of the 438 participants, 9% of you chose to insert your company in the comments section. And I'll tell you right now, I feel like it's going to be impossible to make a dedicated deep dive video for every single one of these companies that you see on your screen right now, right? I think prior to my baby girl being born, I think with my work ethic, I could probably have done it. But these days, time is a very valuable resource. I barely get any sleep. So I decided in this video today, I'm going to do a hot take, rapid fire, straight to the point for every single one of these companies that you guys have listed that I just don't have the time to do a deep dive on, okay? And here's my disclaimer. I'm not invested into any of the stocks. So if you feel like there's any bias or I'm discriminating against a company, you can blame your wife's boyfriend, okay? I'm not invested into any of them, but I may or may not have worked at one of the companies that we are going to talk about. So to kick things off, let's go ahead and start off with Pinterest, okay? So Fran T. Sekholkik, I'm so sorry. Pinterest, please look at the valuation. All right, let's do it. Let's look at Pinterest. From my understanding of the social media space, I think Pinterest is really popular with middle class women aged like 25 to 45. They usually use it as like a like a bulletin to get their wedding lookbook ready, like what kind of concept that they want. And a lot of old people like Pinterest as well. But when you think about the millennials, like males or Gen Z, dude, Pinterest is probably at the bottom of the barrel of what we gravitate towards. But anywho, let's give Pinterest a fair take. So right now they're $24 a share, their 1 year range. Oh my goodness, yeah, they're at their 1 year low, as evidenced right there. I mean, about $1 above it. They had a high back in February and in the tail end of summer, roughly $40 a share. And during the pandemic, they reached a high of almost, $85 a share. Wow, they have fallen quite far. The trading multiple is an 8. I agree with the individual saying that their valuation looks cheap, but just because the valuation is cheap, it does not mean that it's cheap. Sometimes the market makes a stock trade for a cheap valuation because they're crap, right? But in the case of Pinterest, I mean, let's let their numbers do the talking. I did not expect that. I'll be completely transparent with you. I did not think their top line was going to be this magnificent, especially, okay, so it seems like in 2022, that was the only single digit, no, in 2023, but other than that, I think that's phenomenal. So what I'm looking at is this row right here. I care about the percentage change year over year. I think when it comes to like data and a large amount of numbers, you don't just want to look at the numbers, you want to look at the percentage change. Because like, for instance, with Pinterest, right? They generated $4 billion. And another company, they might have only generated like $200 million, but you want to look at the percentage change to see what's more impressive. Now, I would argue once you get up there and you're pumping like, $500 billion quarter after quarter, it gets kind of hard to get to like the next level, right? But when you're scaling, you're accelerating your growth, you're a startup, I think going from like 200 million to 300 million seems more feasible, but still, I think Wall Street really cares about the percentage change. I would argue this is pretty good. So why am I focusing so much on the top line right here? It's called the top line for a reason, right? The gross sales of revenue. It shows you essentially whether or not a company is expanding. So think about it like this. If you're an entrepreneur, a business owner, you took an economics course, accounting, whatever. If you have not, I'll give you the 101. When you assess a company, the first thing that you want to know is, are they growing? Fundamentally, objectively, are they making more money? right? And to do that, one of the first variables you should look at is the top line of the income statement. Because then it shows you like, okay, this company, they're scaling. They're generating more money than they did the year prior. So Pinterest right now, right off the bat, I like what I see. Now, scrolling on down, the next thing I want to look at is their shares outstanding. Basically, I just want to get a good gauge and assessment of whether or not they're buying back their shares. And it seems like not really. I mean, they did in the past 12 months. It's reduced by about, what would you say, 8 million shares, roughly. Not bad, could be better. And then I want to look at this one right here, the earnings per share. That's essentially the bottom line per share. So when you think about all the profits on an accounting basis, how much the company is putting into their pockets, divided by the amount of shares outstanding, this is what we're seeing. So kind of in contrast to their revenue situation, I think this is really inconsistent and actually kind of hideous, right? I think leading up to 2024, it was volatile, it was negative. They were bleeding cash in order to run the company. But for the past 2 years, I think a case can be made that this is really impressive. So far, I think Pinterest, I don't know, is it a hidden gem? I mean, let's take a look at their books. So when people say books, they're referring to the balance sheet. It basically records all of the money that's flowing into the company and all of the money that's flowing out. And what's interesting about the balance sheet, I made a dedicated deep dive video talking about how to look at a balance sheet, but all of the assets that a company calculates, like all the factories, all of their intellectual property, all of their trucks and everything, what else, it adds up to the total liabilities and shareholders' equity. So it's a balancing act, and that's why they call it the balance sheet. And I think it's kind of interesting. Now, with ADHD, I had no idea that I would fall in love with accounting because I was never really a math kind of guy, but damn, accounting is actually really interesting once you get to know the basics of it. But anyways, a few things that I'm going to be looking at. I'm going to be assessing their cash and liquidity situation because if a company is flush in cash, low in debt, I would argue that's the definition of a good balance sheet, right? So right now they have $2.6 billion. It's looking pretty good. To that of their total debt situation is $200 million of debt. So when you take into account all of the short-term obligations, the next 3 to 5 years, all the loans, and everything else, 20, 30, 40 years down the road, $200 million in leverage. That's not bad at all. So if you use the cash on the books to pay down the debt, they still have $2.4 billion of cash left over. That's what the net cash to debt ratio tells us. I think their balance sheet is pretty darn good. Let me see if there's anything else that I can call out that looks unusual. If not, I think this is pretty darn good. Yeah, not too bad. Next thing we should probably take a look at is the cash flow statement. And the only line item that really matters here is the free cash flow. So unlike the income statement, if I jump on over here, this is all accounting, engineering, and manipulation. You can make your company look profitable by altering some of your numbers. You can make your company look unprofitable by also altering some of your numbers, such as writing down an asset, increasing your goodwill. You can manipulate the numbers. With the cash flow statement, you can't do that. That's why the free cash flow for me might be a little more essential than the net income, because the net income is the profits, but the free cash flow are the cash profits that are going into the pocket of a company, the real cash from the operations. So what we're seeing is $1.1 billion of free cash flow. I'm going to be honest with you, dude, why is no one talking about Pinterest? I just made a dedicated deep dive video talking about Meta, right? One of the biggest conglomerate social media companies, but dude, Pinterest? I think their numbers look pretty solid. Again, what we're looking at is this one right here, right? The percentage change year over year. I think their free cash flow situation, yes, it is slowing down year over year. Likewise with their revenue, it's stalling a bit, but it's still pretty darn juicy, wouldn't you say? Free cash flow per share looks pretty good as well. I would argue they're in a financial position to be able to afford a dividend. They're flush in cash. They're profitable. It might behoove of them to introduce a dividend. I think this is a company that is probably shooting themselves in the foot by not paying a dividend. So my takeaway from this, I'm going to be taking a deeper look at Pinterest because the last time that I truly analyzed this company was back in 2020 during that craze. Do you remember during the pandemic, almost every growth-oriented stock just ballooned up in valuation? And so I think Pinterest was one of those companies where I took time, like on my own as homework, to really analyze to figure out if it's worth that valuation. And I'll show you what I saw back in 2020. I was seeing a growth of 48% year over year for their revenue, their top line. But I think it was their EPS that made me say no. Yeah, so back in 2020, they were generating negative 22 cents of profits per share, meaning they were losing money in order to operate the company. So I think I dismissed them, but dude, that was 5 years ago. So based on what I just saw, I think that guy is onto something. I think Pinterest, I think it looks pretty good. But again, I think some of the stuff that I'm going to be looking at later on is like, what's their active daily users? What's their advertising budget? What's their growth drivers? And some other stuff like that. So if we hop on over back here, let's take a look at what is the next company we should be dissecting. I think it's this, Fermi. It's a new micro nuclear power stations for the data center. So whenever someone says data centers, it's basically synonymous with the AI movement, from my understanding, right? Because the data centers are powering all of the language learning models. Case in point, AI, right? OpenAI, Gemini, and then Perplexity. I used to like Perplexity, but dude, in the past 3 months, I have not logged into Perplexity. I've only been using Gemini and OpenAI. And these days, I would argue 80% Gemini, which is Google, and 20% ChatGPT. I used to use Elon Musk's Gronk or whatever, but I don't know. I haven't used them either, at least since like summertime. So let's take a look at Fermi. As I just said, the initial public offering, which is when they debuted in the stock market, I think a few weeks ago, right? Yeah, back in October 1st, 2025. And let's take a look at their profile real quick. This is not a company that I'm too familiar with, but I would argue when it comes to nuclear energy, I am pretty bullish. I think that's the next inevitable step that the US is probably going to gravitate towards. I think for the longest time, we knew that nuclear was really good, but the fallout and whenever there's like an explosion or something goes wrong, I think the public perception of nuclear energy is scary. It's toxic. It's terrible. It is. It actually is. But if you can contain it, nuclear energy is one of the more efficient ways to generate energy, from my understanding. So take a look at this. So they're categorized as a REIT, which means they have to, by law, pay out at least 90% of their earnings out as dividends. And let's see, it's pioneering development of next generation electric grids. There's no mention of nuclear here. Oh, there it is. Expected to be one of the largest nuclear power complexes. So I think stock analysis does not have their dividend profile loaded yet. I'm not seeing it here. So wow, this stock is so new. They don't even have their financials uploaded here. So, I mean, based on what I understand of nuclear, I'm pretty bullish. Looks like the price forecast is $30, which from at its current trading price is $14. That's an upside of 100%. I can't really analyze. I'm a numbers kind of guy, right? We can talk all we want about narrative, hype, and story, but we have to look at the numbers to really make a true and accurate assessment. It's kind of disappointing that their numbers are not uploaded, but yeah, maybe this is one of those companies we can circle back on. But are they cheap? I think with a PE ratio of a 73, I think one could argue they're pretty darn expensive. But I think the business operation that they're operating in, it is a pretty exciting venture, in my opinion. So this is something that I cannot give a proper opinion for because there's no numbers to look at, right? Okay, what's the next one? Pinterest, again here. Zoetis. Oh, okay, Zoetis, a company that I am familiar with. I think they do pharmaceuticals for animals, livestock, to keep our cows, chicken, our pigs healthy. Let's take a look at it. Engages in the discovery, the R&D, manufacturing of commercialization animal. Yeah. So basically the pharmaceuticals for animals. Now, I'm not shy about it. I always state my opinion. I used to be a strategy leader in one of the biggest pharmaceutical companies in the world. Think like Pfizer, Merck, etc., right? I have a pretty good understanding of this space. For me, I'm not particularly bullish. Now, I am going to expand my opinion later when we talk about some of the more human-oriented pharmaceutical companies, but for Zoetis to see a drop off a cliff like this, I think it's I think they're being punished alongside with the human-oriented pharmaceuticals because they are also getting shattered right now. Someone's taking a hammer and smashing their kneecaps in. But it looks like with Zoetis, their revenue is slowing down. I think during the pandemic, they had a really nice rally, 16% growth year over year. But to see a 2% growth, it's kind of disappointing, but it makes sense. I think with inflation, it's probably... I think their clientele and their customers, they probably stocked up on dewormers and other medicines that they give to their cows and chickens and whatnot when it was cheaper because they probably had the forecast to be like, okay, because of inflation, the same drug is going to cost 30, 40, 50% more in the future. So why not just increase our inventory right now? So I'm guessing that's why their revenue is not exponentially growing year over year, but I could be wrong, right? See, when it comes to analyzing a company to make a dedicated deep dive, I spend a minimum 72 hours just looking at everything. Right now, like I said, this is a rapid fire, hot take, unpopular opinions. Yeah, but you know what? The efficiency of their margins getting way better. So even though their revenue seems to be slowing down, I really like what I see with the bottom line per share. I mean, that's phenomenal. 2015, we're talking about 68 cents, and now it's $5.94. I think that's pretty impressive. Again, I'm not really bullish on the pharmaceuticals, but when it comes to our animals, I like it. I like it better than the human-oriented ones, because when you think about the clientele that Zoetis is selling their products to, we're talking about the veterinarians, we're talking about farmers, we're talking about, I guess, like, government agencies to make sure there's not weird viruses and whatnot in our waters for trout, salmon, and everything else. So when I think about it like that, I like. Because when it comes to pharmaceuticals for humans, there's so many regulatory hurdles. That there's the whole issue of like health insurance versus the actual cost to manufacture the drug. And pharmaceuticals as a whole just gets a bad rap, right? So, I don't know. But when you think about animals, I feel like it's a different ballgame. $2 billion of cash, total debt, $7.2 billion. That's a lot. For a pharmaceutical, that's a lot. They're usually more flush in cash than they are with debt. So once you pay down all of the debt on the books with the cash that they have on the books, they still have $5.2 billion of obligations. That's not very good. They do have a dividend profile that I think the growth rate is pretty darn juicy. It's absolutely sustainable, meaning for the $2 of dividends that are paid out, they're utilizing 33% from the earnings per share that we saw earlier. It was like $5 and whatever cents. So very sustainable. The growth rate is juicy. Yield could be better, but I think it looks pretty squared away. I think Zoetis makes a lot of sense. Can't argue with this one. Let me just get a sip of water before we continue. Let's see what's next. Did I tell you what, man? When your throat is perched, or when you wake up from a good sleep, which I haven't gotten in the past like 4.5, 5 weeks, water just hits differently. It's one of those things that you take for granted, but man, if you're a running kind of guy, or you bike to work, or you go hiking, that first sip of water after you've been sweating your balls off for like an hour in the sun, yeah, dude, water is just, I love. So this individual said team, and xie, I think that's what that says in Mandarin, or Cantonese, I don't know. So team. So that actually stands for Atlassian Corporation. And basically they're in the business of selling project management software. I'm going to tell you this right now. Everybody that's operating in the exact same space as Team, including Salesforce, Asana, and Monday, they're getting obliterated, right? Because I think the fear on Wall Street is that AI is going to make project management stuff obsolete because AI is going to integrate it into Gemini, into Microsoft's own Word, onto their own cloud, and etc. And to a certain extent, I think that's all hypotheticals, but I think there is some merit to that, right? So when I think about Team, this is a company that used to be on my watch list up until I think the beginning of this year. I deleted them alongside with Monday and with Asana. But backing up a little bit, Atlassian, it's the parent company of Jira, Trello, and Loom. Loom is a software where you can pre-record videos to send to your team so that you don't have to be on a synchronous call to be like, hey, everyone hop on. You're butt naked. And it's like, oh my gosh, I have to jump on a call. So you don't show your face on screen. But with Loom, if you're the project manager, you can record your 10-minute spiel about, hey, we need to touch base about this. We're trying to go GTM in the next 72 hours. But the marketing team is having problems with hashing out the contracts with the DSP, trade desk, and then they have to link up with the sales team, and then they have to link up with the FP&A team to make sure that our budget still makes sense. Instead of everyone wasting their time on that stupid call, with Loom, you can just pre-record what you have to make sure your team is on the same page with. So I like Loom. I do like Jira. And I like Trello, right? I personally use Trello to stay organized with my YouTube endeavors. So I actively use their product and I like it. When we take a look at their performance, negative 39%. I mean, as I just talked about, right? Everyone that's also in the software space like Adobe, but actually let's talk about their peers, right? They're also just getting butchered. It is not an exclusive beating to Atlassian. Everybody that does software as a business that used to be a darling, right? With low overhead costs, high margins, they're getting smashed. So it's not exclusive just to Atlassian, but I do think there's too much hype into AI making them obsolete. But hold on, let's jump on back over. Oh my gosh. Let's just go by the ticker symbol, Team. They're getting hammered, but I do believe during the pandemic, they ballooned up in valuation. Yeah. So everyone else that was a quote-unquote growth stock, they also ballooned up. They were $458 at one point. Past 5 years, I mean, it's not really a pretty picture, right? Jump on over to their financials. I think that growth is pretty phenomenal. So you tell me. I feel like there's just so much, what do you call it? Exaggeration and on how AI is making these software companies lose steam. Because if that's the case, I mean, their numbers would be reflected with red, right? I mean, to see it be growing 14%, 22%, 20% quarter over quarter, year after year, I feel like there's no merit. And that's why I've been buying the fear. I've been buying into software companies because I feel like it's overblown. And I think eventually it will correct itself. And one thing to take into account is like these software companies, it's not like they're anti-AI, right? I bet they're enabling AI in all of their features and settings, right? It's like they're integrating it into their product updates. So I think Wall Street, I think they're getting it wrong. But here is something that I really don't like. They're not a profitable business, right? Negative 70 cents of profits per share. Their net income is just atrocious. It is really bad. So if I were to make an educated guess, it's probably because of the M&A, the acquisitions that they've been making to buy out the other software companies. It's taken a huge hit on their books. So to truly see if they're printing cash and if they're flush in cash, let's take a look at their free cash flow. Yeah. So $1.4 billion of free cash flow lets me know that everything is okay. I don't think they're a dividend payer, are they? No, they don't pay a dividend. They could pay a dividend, but I don't think they should because their EPS is negative. So when you do the payout ratio, like uninformed investors will see that their payout ratio is like a bonkers number and say, oh, they're a piece of crap. But if you were to do it by the free cash flow payout ratio, then you would know that it's sustainable and it's pretty good. I'm going to go ahead and assume that their books look good Because again, when you think about like Procter & Gamble, General Mills, which are two companies that I am invested into, they have a lot of overhead costs, right? There's a lot of manufacturing, there's a lot of factories, there's a lot of moving parts in order to make shampoo, a shaving razor, or cereal. When you talk about software as a service, SaaS, there's no factories, there's no truck drivers, there's no robotics, machinery. So they're going to be inevitably flush in cash. If you are a software company and you're burning through cash, that to me is a huge red flag. And that's why back in the day when I bought into Palantir, I think as a SPAC I bought into it, or maybe when they IPO'd at about like $8 or $9 a share, I bought into it because even though they are a software company, they were just crushing it. As a startup software company, they were crushing it. Because usually software companies, they are negative initially until they can get up and running, and then they become profitable. Because once you secure more contracts, with the same amount of employees, say you have like 250 working members in your organization, and you're generating like $1 million, and almost all that goes towards your SG&A, which is the compensation for your employees. Imagine when you secure more contracts with more firms, more enterprises, and it bumps up to 5 million. So you only really need $1 million to run the business, right? That means there's $4 million that's left over to reinvest into the business of profits, R&D, marketing, and whatnot to scale. So with Palantir, they looked really different. And that's why back in the day, like 5 years ago, whatever, when people were like, oh, Palantir is a fake business. On the surface level, maybe, but their numbers looked phenomenal. But anyways, $1.2 billion of debt. They have $1.5 billion of cash left over. I think that looks phenomenal. I think if you're invested into Atlas, and I don't blame you, I think there's a lot to like about this. One thing that I do want to take a look at, though, is their ROE, because it is a software company. Return on equity. Ooh, boy, that is not good. Yikes. So all of the fundamental metrics are in the negative. So they're not generating a good yield or return on investment for their capital that's employed from the shares outstanding or from their assets. This is really bad. So it's not a efficient company, in other words. Okay. Well, that's a yellow flag alongside with the EPS being negative. I take back what I said. If you're invested into this one, that's not financial advice. I would just reevaluate. Because when you take a look at their peers, I don't know, like Salesforce, the parent company of like Tableau, is it Teams, Slack, and a few other software. What was they have something else that's like really important besides the customer management platform and HR stuff. I feel like I'm missing something. There's something that Salesforce is also really famous for. Hold on. Tableau, Slack. Okay, whatever. There is something else, but here's the difference, okay? They're also growing year over year. It's flush in cash, looks phenomenal. It's predictable, reliable, beautiful. But take a look at their bottom line per share. That's just phenomenal, right? This right here was because they had to take a hit on the books for acquiring and buying out other companies. Salesforce is one of those serial acquiring companies. They keep buying out tiny fish that have huge potentials, and that's how they keep growing the revenue. Some people not a fan of that. I like it. Whatever it takes to grow the revenue, I like. Some people are like, oh, inorganic growth sucks balls. And I'm like, dude, if you understand business, sometimes your product or service can reach maturity, meaning it already penetrated everybody in the market, and you can't just keep raising the prices like Adobe, right? Eventually, you do need to roll out something else. That's why Procter & Gamble, they essentially grow their revenue through acquisitions. They keep buying out the new soap bar, the next diaper, the next laundry detergent, whatever. That's how they grow their revenue as well. I guess once you understand conglomerates and the Berkshire Hathaway mindset, inorganic growth is not bad at all. The people who paint it out to be bad, I think they can be a little narrow-minded. Obviously, organic growth is the best, but it's also not feasible once your product, service, or food hits market saturation. Okay, if that makes sense. Anyways, their ratios. I think that's the point that I was trying to get across here. Yeah, so ROE 11.2%, ROIC, I wish it was 10%, but 7.3 is pretty good. Huge difference between Salesforce and all of their ratios and fundamentals looking positive and trending up versus Atlassian. So yeah, I think that's a clear, drastic contrast between high quality software versus kind of a low quality. I mean, I love Trello, to get me wrong, right? I think there's a lot of stocks where the product itself might be phenomenal, but the financials and fundamentals might be doo-doo. Hold on, let me drink some more water. Or, in the case of like Crocs or even like PayPal, product and service is phenomenal. Numbers look good, but the stock itself is treated like it's a tumor, like it's a pimple on your ass crack. It's just not palatable to Wall Street. I think that really puzzles me because, like, I did a deep dive on PayPal not too long ago. Like, everything about them checks out. They look great. They're scaling. They're constantly doing R&D, rolling out new features, and they even implemented that dividend that I kept complaining about. There's so much to like about PayPal, and yet they just get no love from Wall Street. And I'm going to be completely transparent with you. I was eyeballing jumping in, and then I made the executive decision. It's like, dude, I think because Wall Street does not like PayPal, I mean, for the past like 4 years, they're flat, right? What's the point? I think it's like one of those, what's that phrase? Money in dead water or something like that. You can put your money into it, but it's basically going to be flat. So it might behoove you to put it into something where your money can move upwards, right? And so PayPal is one of those unfortunate examples of high quality numbers, high quality fundamentals. And I like their service and product, but the stock itself, that's where there's a disconnection. And yeah. Anyways, going back to the poll. Okay, here's a human-oriented pharmaceutical known as Eli Lilly. Let's look at them. I actually have quite a few friends that still work for Eli Lilly, which, so I do have line of sight of that company. I think it's really high quality. They do treat their workers well. I think it's headquartered in Indianapolis from what I remember, somewhere in the Midwest. I don't think it's Chicago or Detroit. I'm pretty sure it's Indianapolis. And I think right now their big product is the Zepbound. I think that's their answer to Ozempic. And they're also rolling out some heavy-hitting diabetes drugs, which, as you know, as Americans, we have pretty bad rates of diabetes. Yeah, our lifestyle here in the U.S. is kind of a shock to other people around the world. But that's because we also serve the best food, pound for pound. I don't care what you say. You can come at me. The reason why we as Americans are fat is that our food is so freaking delicious. Do we need to add that much butter to the steak? Probably not. Do we need to add that much seasoning? Probably not. But as a guy that lives in Japan, yes, the food is fresh. Yes, the food is clean, but it lacks substance and flavor. It just doesn't taste that good, especially when you think about pulled pork, barbecue ribs, when you think about General Tso's chicken, when you think about Chipotle, when you think about a quarter pounder with cheese, Domino's pizza. Yes, the Japanese people have their own version, but it's just not as delicious. Dude, I've been living here for 3.5 years. I think I'm entitled to my own opinion. I think at first I was a fan of how it was so fresh and clean, like everything that they serve here. But eventually I got sick of it. I was like, dude, why is everything here? Y'all need to start soaking your food, deep fry it, put it in butter, make it more unhealthy. But I think that's definitely the American mentality in me. Obviously, that's why the Japanese live, especially places like Okinawa. They can live to like 90, 95 easily. Whereas us Americans, like, we do have the ability to live longer, but dang, our lifestyle choices, we don't work out, we're fat, we're stressed out, we overwork ourselves. So I think we're lucky to see like 72, 74. Yeah, kind of interesting stuff. But anyways, Eli Lilly, taking a look at them, I think they're one of the more better performing pharmaceuticals. Yes, I mean, they're crushing it. They're at their 1-year high, past 5 years. you would have 7x your money by investing into a pharmaceutical, right? That goes entirely against what I always say about how I would never invest into a pharmaceutical. Lo and behold, there's one that would give you 7x on your initial investment. Sorry, I'm burping. 5 years ago, which I think is pretty crazy. And when you think about their peers, right, their rivals, like Pfizer, dude, they're suffering right now, right? Negative 31% past 5 years, past 1 year, flat, 0.4% into the green. You know, one can make the argument they're all doing the exact same thing, right? The differentiator, though, is when you think about Eli Lilly, their drugs and their pipeline, I don't know how, but they're just hitting success after success with their clinical trials, and everything that they're rolling out is just effective. Whereas with Pfizer, some of their more heavy-hitting drugs, the patents are wearing off. And if you know anything about the pharmaceutical space, it's all about the patents. Once the patents wear off, like I can pull up Amazon.com right now, and you know how Tylenol, that's the name from Johnson & Johnson. Oh, it's not Johnson & Johnson. Kenvue. It's the acetaminophen or whatever, right? The painkiller. Once that patent wore off, dude, generic brands sell the exact same drug at a fifth of the cost. So if you're a budget-conscious consumer, are you going to buy the name brand Tylenol for like $20 for 50 pills? Or are you going to pay $5 to get 200 pills? The generic brand, right? The exact same argument can be made for the allergy pills that are good for 24 hours, like Zyrtec, Claritin. I think it's like $35 for like 50 pills. Whereas if you go to Sam's Club or Costco, you can get 365 pills for a little over $14, right? So with patents expiring for Pfizer's entire portfolio left and right, and how their clinical trials and research drug pipeline is hitting setback after setback, that's the difference, right? With Eli Lilly, everything seems to be going well. And oh my gosh. So in 2022, their revenue was pretty much flat, right? 28 billion to 28 million year over year. But look at what's happening. And that's because from my understanding, I do like to stay up to date with the pharmaceutical space, because if YouTube eventually doesn't work out or whatever, and I need to pivot back into corporate America, I probably would start interviewing with pharmaceutical companies again. It's one of those things where it's like, if you are good at something and you worked in it previously, I feel like that's an easier field to pivot back into, right? Like if you're a teacher, you had to take a sabbatical because you were raising your kids, and you go back 10 years later, I feel like a school will take a chance on you. Or if you're a banker, you're good with numbers, you leave for like 5 years to backpack around Thailand, making out with ladyboys, but you decide you want to go back into, I don't know, the back office, front office, investment banking, or what have you. I feel like if you have a resume of where you worked previously at Goldman Sachs, I'm sure a boutique firm will give you a chance. Likewise, I'm sure if I ever wanted to hop back into corporate America, I'd probably go back to a pharmaceutical. But anyways, I digress. Zepbound, which is their answer to Ozempic, apparently right now they're working on getting, I guess, approval from the U.S. approving agencies. Gosh, I'm getting a tongue tie right here. But anyways, because Zepbound, it's also known to reduce and stop entirely when it comes to cravings and addictions. Not just for like savory snacks and foods, but also gambling and alcohol. Just think about it like that. Imagine that there's a drug that you can take, and I'm sure the side effects are going to be pretty wonky. Like you're going to grow a tail out of your butt, or your balls are going to get shriveled up and your testicles disappear. I'm sure there's going to be some kind of side effect for a drug that's going to get rid of cravings and addictions. But dude, that's a game changer. I think that's really freaking exciting. Yeah, gross sales, obviously when it comes to the big pharmaceuticals, they're always going to have pretty stellar financials. That's what they're known for. My goodness gracious. I mean, the growth of their profits per share, 120% year over year, that's just disgusting. That's just absurd. Taking a look at their free cash flow. Yeah, dude, Eli Lilly right now, they're crushing. They're killing it right now. It's basically 3xing year over year. That is insane. I'm sure their balance sheet will look just as phenomenal. Yeah, this is beautiful. So I don't even think I need to look at any more data numbers. I mean, I think we can all conclude that Eli Lilly is phenomenal. Here's my thing. I think the ship has sailed, right? If I were to change my opinion, I'd buy into a pharmaceutical, Eli Lilly would not be on that list, because why would I buy into a company that's already skyrocketed to the moon, right? I think the upside from $1,059 a share, I don't think it can go much higher, at least for the next 365 days, right? I think for the downside, though, if there's any setback, if the CEO farts into the mic during an earnings call, dude, this stock could easily go down 20, 30, 40, 50%, right? So for me, I wouldn't want to buy into it while it's at an all-time high. But having said that, if you bought into it, like say I bought into it when it was like 350, I don't know, maybe 360 a share, I would start calculating some profit taking. I'd be like, okay, I've 3x'd my money at this point. I don't think it's the worst idea to take some profits. But obviously, there's also that Peter Lynch philosophy of letting your winners ride higher. Because, who knows? Eli Lilly could be $2,000 a share. I say that because with Palantir, I mean, if you bought into them at like, I don't know, $20 a share, or even at their lows of like $9 a share, if you sold out of them at like $75, I mean, I sold out of them at $40. To this day, I know I always share that story. I kick myself in the head because I bought into it at $950, $980 a share. I got to look up the receipts for that. And once it hit 40, I was like, dude, I've essentially 4x my money. I'm out of here. Had I just held on to Palantir, dude, it's a compounder, right? So it's one of those things where you have to gamble. Like, is it gonna go much higher, or is this the peak, right? We're going to be taking a look at one of those companies where they did reach that peak and then they've just been free falling ever since. So there's an argument to be made for both sides. Like, do you keep riding higher, or do you sell, capitalize on the profits? Because secured profits is a lot better than watching your gains fall every single day, week after week. I've been there before, but I think that's why these days I just capitalize on the profits. I think Eli Lilly, taking away my bias of not investing into pharmaceuticals, I'm bullish on them. I think it's a pretty solid company. Anyways, let's go back over here. Nico828. Why does this say translate to English? What would that be? Ship? Anyways, he said Melly. So let's go ahead and look that up. This is the next one. Oh my gosh, the sun came out. Let me close my curtain. And it's Mercado Libre. It's the Amazon of Latin America, from my understanding. Take a look at their performance. It looks like 30 days out, negative 7.1%. Year to date, it's not too bad. It's about the same as the S&P 500. The past 1 year is pretty bad. 1% into the green. Past 5 years, 37%. For a company that trades for roughly $2,000 a share, I want to see when they made most of their gains, right? Because, I mean, it takes time for you to hit $2,000 a share. So let's zoom out. Looks like they IPO'd back in 2007 at $32 a share. And it looks like during the pandemic, that's when they really amplified and compounded. My gosh. So August 2021, if you bought into it at $1,946 a share, after 5 years, you would have broken even right now. You would be flat. Do they pay a dividend? They don't pay a dividend. So you would just be flat. And that's why I talked about it earlier. Sometimes, profit taking, it's not a bad idea, right? Like, maybe you bought into it at $1,946 back in August 2021 because you thought it could go up to $3,000. But what happened in the following weeks is it just kept going down and down. Imagine your stomach. Imagine your wife being pissed off at you at every single dinner meal. Like, how stupid of you, huh? You put our entire mortgage into this company and it's 60, 70, 80% into the red. And after 5 years later, you'd be break even. And that's why I'm like, when a company reaches an absurd valuation, I don't mind selling out of it. Because as they go on a dip or on a sell-off, which even the strongest companies like we saw with Palantir, they usually go on a dip eventually, right? Whether because it's a market cycle or everybody gets punished across the board or because of a scandal, and then voila, there's your buying opportunity. Now, to be fully transparent, a few companies that I sold out of at the beginning of this year at a pretty hefty profit, and then I was like, okay, I'll buy back in. One included Google. I sold them for a pretty sizable gain, and then I bought back into them March and April, meaning thousands of dollars. They were my biggest holding by far. And then I sold out of them pretty recently. And then another one was Target. I sold them in like January or February when they were at their top. I did not know that Target was going to go on a massive sell-off. I had to sell them in order to buy more AMD. But yeah, I sold out of Target, and now they're going on a sell-off beyond belief. And I'm watching them day by day and I'm trying to decide whether or not I want to jump back in. So for me, that's kind of like one of the strategies that I apply. I like to buy high quality compounders on the low. So when they're near their 1 year low price, like somewhere like right here back in December, 1,600. I don't like that number, 666. Let's go back to, all right, 1,700. And then once they reach like 1,800, I sell out of it, right? Because then eventually they'll reach back down and give me another opportunity to jump back in. Or I guess not 1,800. What's a better example? Okay, 2,200. Because eventually they'll jump back down and I can buy back in at 1,800. I can repeat that process, rinse and repeat. And instead of gaining like a 14% gain, by doing that methodology, I get like a 30-40% gain. Obviously, timing the market is a stupid idea. That's why I'm an idiot. That's why I do it. I'm not recommending anyone to copy what I do. It's what I do. I'm just sharing what I do. But yeah, going back to Mercado, it's the Amazon of Latin America. They are an integrated e-commerce giant. So when you think about American Amazon, you can buy stuff to shove up your butthole. You have to get $35 in your shopping cart to get free shipping. Almost the exact same principle with Mercado Libre. And they're also a fintech giant. And just for fun, if we think about another community continent, the Amazon of Africa is Jumia. Basically the exact same thing as Amazon, but looking at them, my gosh, their numbers are pretty much flat since 2015. So I'm not a bad guy, I promise, but I'm not too bullish on Africa. I think when people talk about like the emerging markets and everything, I'm really bullish about India, Southeast Asia, in particular like Indonesia, Philippines, Singapore. But Africa, I'm not too bullish. I'll be honest with you. South America, I think it's a mixed bag. I think South America has a lot of potential, but from my understanding, like some of my best friends growing up, they were from Bolivia, Brazil, Peru. They told me there's rampant corruption across all of their municipals, presidents, prime ministers, what have you. There's so much corruption that business there is almost like trusting a Chinese company that's based in Bangkok, or not Bangkok, my bad, Beijing, right? With the CCP and everything. There's a lot of like factors that you also have to think about. Whereas with like American companies, yes, there is corruption, but at least you know the numbers are going to be transparent. At least you know the numbers are going to be accurate. With like a Chinese company or some of these South American companies, the numbers, they might be manipulated, right? That's why I'm like, I hesitate a little bit. But taking a look at their revenue, I think it looks phenomenal. This is beautiful. 2015, we're talking about $650 million. Now it's $26 billion. Are they profitable? Please tell me yes, sir. They are. $40.97. When did they go from being unprofitable to being profitable? 2021. It went from negative 8 cents a share, $1.67. So you riddle me this. A company that generates $40.97 of earnings per share, why do they not have a dividend profile? Doesn't make any sense. Oh, they used to. So what happened? They paid a dividend up until 2017, and then in 2018, I guess something happened. They're like, we're not going to pay you a dividend, por favor, anymore. Ti amo. I wish they still had a dividend. Take a look at their balance sheet. Oh, come on. I feel like they could have more cash on the books. But If they are truly the Amazon of Latin America, then they're probably reinvesting a ton of capital back in to open up more warehouses, fulfillment centers, delivery hubs. So I guess that makes sense, but I kind of wish they had more cash on the books, especially in relation to how much money that they're bringing in. Before I clicked the balance sheet, I thought they would have at least $10 billion of cash, but doesn't seem to be the case. Yeah, CapEx heavy. This doesn't shock me at all. So you might be like, well, Amos, $5.8 billion of cash left over. Of loans left over. This must be pretty bad, right? Well, let's take a look at their debt to core operating earnings to determine that. A 3 and below is the golden ratio, okay? For Mercado, it's a 2.3. So it would take them roughly 2 years and 4 months to pay off all of the loans on the books if their EBITDA remains the same. So if they don't raise their EBITDA, their core operating profits stay the same, they can pay off all the loans. I think that's not too bad, especially for the numbers that they're generating. I think this is a pretty good company. I think I like what I see. Are they free cash flow heavy? I think they should be, right? $169 of free cash flow per share. I think this is good. I'll be honest with you. This is a company that I do want to look into more, but the valuation itself in terms of the price point, $1,900 a share, dude, that's a lot, man. I know, like, if you look at it right here, it doesn't seem too bad. It kind of reminds me of this, right? Like, Costco is also trading at a very pretty penny. It's hard for me to push the button and say, okay, I'm buying into it, because it just costs a lot. Like, I know, like, valuation-wise is not too bad, but I think it's a psychological thing. Paying $900 for one share, it's like, oh man, that's like a sack tap, right? It's like, ooh, that hits kind of hard. But Costco is a company that I am monitoring because I am trying to jump in because they are near their 1 year. Actually, they are at their 1 year low. But I need more of a margin of safety baked in because I think their growth is it's at a single digit year over year. Yeah, 5%, 8%. So for me, I personally can't justify this kind of PE. For these kind of numbers that they're executing, if a company like, I know, I don't want to keep using this example, I'll use another one. But with Salesforce, they're also generating like 8% revenue growth year over year. And their PE, forward PE is an 18. So why does Costco, who's pretty much, their percentage is 8% as well, why is their forward multiple 44? Right? It's kind of offensive. I'm kind of taken aback. If you want to make your jaws drop, I mean, look at PayPal's PE. It's a 10.7. That is absolutely just, it's like an insult, right? Anyways, I like it. I think you guys are putting me on to some really good stocks. All right, the next one is going to be Novo Nordisk. That is the parent company of Ozempic. Let's pull them up right here. I'm pretty sure they're at their 1 year low. Yeah, they are, dude. Just in the past 365 days, we're talking about negative 54%. So here's a very stark contrast to Eli Lilly, right? Whereas Eli Lilly's flying to the moon, here's a pharmaceutical that's just struggling. Well, past 5 years, 40.9%. Not too bad, but if you zoom out right here, they were listed in 1981 for 16 cents a share. So, do you remember how earlier I was going on and on? I had my panties up in a bunch talking about, hey, sometimes what I like to do is sell when I feel like it's at the peak, whether it's right here or right here, because you don't know when it's going to come crashing down, when the wheels fall off the car, as they say, right? So to capitalize and to sell near the top, whenever that is, probably not the worst idea for me, right? To sell it at 102 is a heck of a lot better than to sell it at 47, right? Or you might be kicking yourself in the head because, oh no, I sold it at 97. Had I just held on, it would have been 130, 142. But with that same logic, that's the kind of individual that would have held on because they're like, dude, I think we can penetrate 150. But did 150 ever come? No, it just went on a sell-off, right? So, I don't know. For me, I feel like I like to sell when I feel like the valuation just makes no more sense, when they're overvalued beyond belief. Like, say my price target for Novo is like $80 and they penetrated to like 84, I think I would hold on. But as I see them balloon up to like 95, then I would go back to the drawing board, take a look at their RSI, take a look at their Bollinger Bands, take a look at their 200-day moving average to kind of calculate like, okay, $80 is what I think they're worth. They're currently 96. I would probably pull the trigger and sell at like 100. I'm just throwing numbers right out of my right nipple. But that's essentially what I would do. Because I feel like if I bought into it right here at like $33 a share and they get up to $100, I 3x my money at that point, right? Or 4x my money. So yeah, I can kick myself in the head and think about how they went to 142. But going from $33 a share down to 47, I feel like I would be very upset with myself. And that's why I'm okay with selling and seizing the profits when I see the opportunity seems to be good. Now, as a long-term investor, sometimes the stock will usually trade at the intrinsic valuation that I think they are. They're not too above, they're not too below. So I just dollar cost average and I just hold on to them, right? But when we talk about a valuation that's 40, 50, 60, 80% above the price that I think they should be fairly trading for, then I sell. And then I'll buy back in later on, just like with Google, right? But anyways, so what's going on with Novo? Because I'll tell you right now, the revenue growth seems to be pretty good. Take a look at their bottom line per share. It also seems to be very efficient. And from my understanding, it's because they cut their 2025 guidance, not by a little, but heavily. And that's because their Ozempic miracle drug that's supposed to help you lose weight because it curbs your appetite. Well, things aren't looking too good with the U.S. demand because I think now there's other people that are selling pretty much the exact same thing. Case in point, Eli Lilly, right? There's other manufacturers that are hopping on this board of like wanting to sell drugs to help you lose weight. I think as a society and as humans, I think we always look for shortcuts because the hard way to do it is to change your diet, right? To work out every day, to do the David Goggins method. But that's a chore. That's difficult. So what's easy? Taking a pill and losing that, like your waistband going from a size 46 down to a 32 by taking a pill, and that's all it really takes. I feel like most people probably nod their head and say, yeah, that's the route that I want to go with. So that's why the demand for weight loss drugs is there, but the economic moat that they once had completely eroded. But I will say this, that is absolutely absurd. $32 billion of cash on the books. Their total debt is $101 billion. Dude, that's insane. So after paying down all their loans, they still have $68 billion of loans, obligations. Dude, that's actually really scary. Let's take a look at their dividend profile because I feel like a lot of dividend investors talk about Novo. Just give me a second. I need more water. At 2.5%. They pay their dividend twice a year. Payout ratio is pretty good. Dividend growth rate is absolutely bonkers. Oh, wait, what? It looks like the dividend is not really... Oh, okay. So it seems like the first 6 months are a little bit lower, and then the second 6 months, it goes a little bit higher, and it goes up on a gradual and on a slow trend. Not bad at all. I mean, I wish for the compounding effects, if you are a drip kind of person where you reinvest the dividends back into your portfolio to buy more shares, you know, the frequency quarterly would be better than twice a year, but I feel like it's negligible difference. Weekly versus biannual, then that would be a huge difference. Getting 52 dividend payments and reinvesting that back into buying more shares, I think that would have a bigger effect and implication than just getting 2 dividend payouts. But let's take a look at their debt to EBITDA ratio, because their debt was really scary. So it would take them about 7 months of their current EBITDA to pay off all the loans on the books. So Even though they have $100 billion of debt on the books, it's not that bad. I would argue it's manageable and it's pretty low in relation to their core operating profits, the EBITDA. It's not bad at all. Free cash flow, I'm going to go ahead and assume they're flush in cash. $65 billion free cash flow. Phenomenal. What's not phenomenal is the trend for the past 2.5 years, going from 83 billion down to 65 billion. That's not good. And the free cash flow per share is also dropping. But tell me this, riddle me this. Are they buying back their shares? Yeah, consistently and reliably. 2015 was 5.1 billion shares outstanding, and now it's 4.4 billion. I'm going to tell you right now, financials and fundamentals wise, it's kind of like the PayPal or even like Sezzle example, right? This is another company, fintech company, buy now, pay later, that I covered on the channel not too long ago. Fundamentals and financials look rock solid, right? Like after taking 2, 3, 4 Viagras in Philippines because you're partying or whatnot. Beautiful situation. But the stock market just does not love them, right? They're also selling off. Now, listen, man, I'm not a fan of the pharmaceutical space, but when it comes to Novo Nordisk, I mean, it's also like Lululemon, right? Beautiful product, beautiful business, financials look pretty solid, growth numbers. But again, Wall Street just is not, they're not in love with it, right? And with Novo, I just feel like there's a lot of fear baked into them because I think Eli Lilly, they're the star child. So you know how earlier I said with Eli Lilly, I would not buy into them because their valuation just makes no sense right now. They're way too high in relation to their historical PE, but also a 51.8. But also with a run up like this, what we talked about earlier, the downside risk is a lot higher than the upside gains. So a gambling person might be like, oh, I'll hang on because I think I'll hit 1,500. But who is to say that Eli Lilly is not also going to get the exact same treatment that Novo did, right? Going from 142 down to 47. So I personally wouldn't want to buy Eli Lilly at its current price and valuation. But all else being equal, if Eli Lilly were to drop down to like 650, 550 a share, I might entertain it. Do I see that happening though? Probably not statistically. If they do drop off, it'll probably be like 850 and then they'll rebound. With Novo, listen, I think it's a pretty high quality business. There is some setbacks with the generic weight loss drugs. And they're also headquartered in Europe, from my understanding. Because I feel like if you're an American drug manufacturer, I feel like the politicians, they want their pockets to be lined with cash, and they'll look out for you. But when it comes to a European pharmaceutical company, you're kind of on your own. You have to make a best-in-class drug. Your pipeline, your research development team, your scientists, and everybody else that's involved in your business operation, they just need to be absolutely phenomenal. Thinking about all of that, if I had to pick between Eli Lilly and Novo Nordisk, a 12.9 PE, financials fundamentals looking rock solid. Actually, before I say that, I want to look at their ROIC, the return on invested capital. When you take into consideration the loans on the books and the shares outstanding, what is their return on investment? A 42%. I mean, that's absolutely bonkers. If I had to pick between the two, I'd probably go with Novo Nordisk. Yes, they could free fall down to 30 a share, 25 a share. Yes, but I feel like the upside to the downside, the risk to reward here at this point, I would jump into Novo. Now, would I actually? No, I would never invest into pharmaceuticals. It's not my cup of tea. But thinking about how they're completely beat up and they're generating the numbers that they are, because look, the thesis would be really different if their revenue was not $315 billion and a growth of 16% year over year. Like if it went negative, then I'd be like, guys, I don't want to go near them. Like I'll give you an example of Pfizer. Like somewhere like here, right? Going from $100 billion down to $59 billion. And then I'm seeing their stock price, it's really low in relation to Eli Lilly. And when I say that, I mean with the PE ratio, then that's stupid. You're buying into a falling knife. But when we talk about numbers like this, 16% year over year, with a PE of a 12.9, it's almost like the health insurance companies right now, right? Even their PE ratio is just stupidly low. It makes no sense to be this low. Well, I think with United Health, it was a combination of the government shutdown, plus their regulatory probing, plus I think in the what do you call it? The Medicare cost reimbursement packages are going to be, I think it's going to be done really soon, and I think there's a lot of uncertainty about that. But take a look at their numbers as well. Absolutely phenomenal. Trading valuation here, for me, United Health is a no-brainer, and that's why what is it? It's like 21% of my portfolio. I put a lot of money into it. With Novo, listen, if I don't invest into pharmaceuticals, but if I had to, I'd do it. I would do it. But would I? No. I think we spent way too long talking about them. Let's move on down. So, my gosh, hold on. Let me get a water break. Oh, man. Okay, so where were we? So, Texas Instruments just made a dedicated deep dive talking about them. Speaking of Texas Instruments, dude, take a look at this. I know the entire stock market has been selling off lately, but check this out. They're almost at their 1 year low of about 140 a share, which is absolutely bonkers for someone that's a part of the AI chip manufacturing space, right? It's kind of crazy to see. If you want more elaborated thoughts on them, go watch the video, right? Let's see. Texas Instruments, Duolingo, we made a video about that. Broadcom, Apple, JP Morgan Chase, Waste Management, Berkshire Hathaway. Every single one of these companies, for me personally, I'm not telling anyone else what to do with your money. Me personally, all 5 of these are buying the dip. They're so high quality that when you start talking about what are the best stocks in the stock market, they belong in that conversation. When they're so resilient and reliable with their revenue and their economic moat just being enormous, it almost becomes a no-brainer, right? Like JP Morgan Chase, I made a video breaking down every bank stock. You can find it on the channel. They're literally best in class out of all of the banks publicly trading in the US. Waste Management, I would argue, is probably second best. I think Republic Services would be number 1. And I say that as a guy that's invested into Waste Connections. I feel like Waste Connections and Waste Management are probably peers in terms of like their prowess, in terms of their ranking. I think Republic Services is number 1. And then Berkshire Hathaway, easily, I think it's an A tier for the insurance space, but they're also a conglomerate that also operates Dairy Queen and Brooks Running Shoes, and Fruit of the Loom, underwear that you can buy like a 6-pack at Walmart for $20. Microsoft, Apple, no-brainers. Copart, I can't remember. I think Copart is the car auctions thing. I'm sorry, guys. I got to refresh my memory. I think it's the car auction thing. Yes. So that's what used car dealerships, they buy their cars from Copart at these wholesale auctions for like, there's a Honda Civic, 120,000 miles. They'll buy it for like $4,000. They'll flip it. And when I say flip it, I mean they'll give a car wash and sell it as is for $6,500 at their lot. Of course, you can negotiate it down to like maybe like $5,900. You'll walk away thinking you got a good deal. But the dealer, he just made a easy $1,200, $400 profit, right? So that's Copart. And yeah, I think the car market is really interesting because when you think about it, I think up until like 2021, I think used car prices were pretty fair, right? And I think that whole line of thought of like you buy a car for 50 grand. Once you drive it off the lot, it depreciates down to $25,000, right? And you only put 1 mile on the odometer. And that was pretty much fundamentally true for the longest time. But now we're living in a weird timeline where used cars are about 90% of the price of a new one. So why buy used is my whole train of thought. And that's coming from a guy that has never, ever bought a new car. I always buy my cars used. From Craigslist, Facebook Marketplace. I kind of don't like going to a car dealership to negotiate. They usually give me a hard time. I have a baby face that also happens to be Asian. So they feel like I'm rich or whatever. I'm not rich. So it's like, dude, cut me some slack here, man. But the credit score, my credit score is like 850. So yeah, probably not the kind of customer a car salesman likes to see. Because they want to make a good profit margin. They're financing their cars, right? So if I have a crappy credit score, then they can slap on a 20, 30% interest rate on that car payment. But anyways, when I think about the used car market right now, it's really bonkers. So I feel like buying a new car makes more sense than buying a used car at this current moment. But speaking of which, I did tune into CarMax, which is a used car dealership that's nationwide. And you can buy a car, say like you're located in Fremont, California, you can buy a car from Rhode Island and have it shipped over. Of course, there's like a transportation fee, but all of their car dealerships are categorized into their online catalog. So I think that's pretty cool. But they also fell off a cliff, right? And I think their guidance going forward was pretty bad. And their inventory is one of those reasons. Like they bought way too many used cars for a premium price, and they're finding it that it's hard to sell it. And I think that's because consumers are not only holding on to their cars for a year or two longer, but they're also just deciding to buy new instead of going used. Because I'll say it again, I truly think it's unfair. If you're the kind of jerk that sells, I don't know, a minivan that has 200,000 miles for like $20,000, dude, you're a jerk. You and I both know that that's only worth about $1,000. Because the timing belt's going to have to be replaced anytime soon. The brake pads are probably non-existent at that point. The tires are probably bald. You know that there's a weird noise coming from the transmission. But to be that jerk that sells it for 20 grand, like, come on, right? And I can't be the only guy that feels disgruntled about the used car market. And I live in Japan. I'm not even in the US, right? I'm feeling for the common person. I'm like, dude, I feel y'all's anger. Used cars should not be selling for this much of a premium. But anyways, I think everybody that's operating in the car sales space is just getting hammered, except probably Carvana. Yeah, Carvana is still crushing it. Trading multiples is 70, forward is a 45. Yeah, their growth is just absolutely insane. But anyways, I'm so sorry, that's my ADHD kicking in. Let's talk about Copart, right? So this is predicated upon the used car market thriving. Now, from my understanding, I think when it comes to the housing market or the car market, I think a big ingredient that affects the prices is the supply and demand. Now, obviously, a little bit of consumer psychology plays a factor as well, but I think supply and demand is probably the biggest variable. If there's not that many houses available on the market and there's more buyers, that allows you to be a seller's market, right? You could bump up the price. Say the market value of your tiny little condo is like $250. But if there's not that many homes available for sale in your area, dude, you could bump that up to $320, $330, right? Likewise, with cars, I think it's also contingent upon supply and demand. And I think right now there's an abundance of used cars on lots that are just not selling. Reason being is that I think people are buying new, or people are just holding on. So when I think about the short term for the used car market, no, I'm going to be completely honest. I am not an expert when it comes to car sales right now. So if you do work in the industry, let me know. Because I'm sure back in 2022, 2023, you were probably crushing it. Your end of the month bonus was probably really pretty, right? But I think in 2025, I think things are slowing down, right? Let me know. No, I'm being serious. Let me know, because what I'm about to say, I need to know. It's just based on my observations from tuning into the CarMax earnings. I think things are slowing down. And so when I think about Copart, breaking this down quarterly, you can see it as well. Quarter over quarter, their revenue is still pretty generous at $1.1 billion, but it's only a growth of 0.7%. So it is objectively slowing down at the auction level. But at the dealership level, I know this is an anecdotal data point because there's many different ma and pa car dealerships, but taking a look at their number, their revenue also dropped 5.2% year over year. So the dealerships are also seeing a decrease, but the auction, the wholesale inventory is also seeing a decrease. So I'll be honest with you, I think my thoughts and opinions on this, not positive. Now, the car market, from my understanding, there's ebbs and flows, right? There's seasonality baked into it. When the times are good, I think the times are really good. But when the times are bad, as you can see, like 2018, it dropped off a cliff going into December. I mean, it went from what? $14 a share down to $12. That's still a pretty sizable percentage change. I think the bigger one is the pandemic one, 2020, January, $23 down to, oh, but that's not fair. That was the pandemic solve. So let's use this one. It went from $38 back in October 2021 down to $28 in May of 2022. So it does have its inevitable market cycles, but dang, that's impressive. 26,000% total return for just their share price. So I think this is one of those things where you gotta be careful. That's not financial advice. I'm just saying it to myself. Like, if I were to jump into Copart, I have to be careful because I think they reached the peak of their market cycle, and right now I think they're free falling until they hit their line of support, until their numbers can do a reverse. Taking a look at their top line, though, what is kind of puzzling is that it's been consistently growing up and to the right. Whereas with CarMax, which is the end point of the supply chain, I guess, their revenue is really inconsistent. Up and down, up and down, up and down. So maybe what I just said is more pertinent to CarMax. And that's why there's peaks and valleys. So maybe with Copart, I don't know, I'm fumbling with my words here. Do you think it's more of like a reliable and steady environment? Or do you think it's kind of like with CarMax, where this like quarterly sales would be highly variable? I don't know. Let me know, because so far the numbers tell me a story that it's not that bad. I don't want to jump to conclusions. I want to take a look at everything before I do. Now, obviously, this is surface level looking, right? We got to look at so much more. Okay, that's not too bad to come to a conclusive decision, and that's what I do for the dedicated deep dive videos. Wow, they have $5.1 billion of cash left over after accounting for the loans. Free cash flow, $1.4 billion. Guys, I don't know. I'm kind of taken aback right now. I'm kind of taken aback at this. Copart, this is not that bad. Are they a dividend payer? No, they're not. That's a brownie point taken away from them. What's their ROIC? 12 per. Oh, well, why is it dropping year over year? That's not good. But it's still respectable with a capital R, 12%. My minimum standard is a 10%. What am I missing here? This seems pretty good. So I think my whole thing is I like what I see, but I just, you know how they say like you should understand what you own? Because when you buy a stock, you're not just buying a stock, you're literally a share owner, which means you're an owner of that business. I don't really understand the landscape of the used car auction market. So I feel like I would do more homework. Maybe this is another one that I can add to my to-do list to take a look at closer. Because I am kind of curious to figure out, like, are they actually undervalued or are they fairly valued, right? Because for all we know, this could free fall down to their previous line of supports back in June, $22, $27, and again at $26.50. So I don't know. Or is this the bottom? Is this the bottom? Only time will tell, right? So, yeah, that's another one I really do want to circle back on eventually. Meta, Melly, we did that. Pfizer, I guess we could talk about Pfizer a little bit. I mean, I feel like we touched upon all the pharmaceuticals. This one I'm absolutely bearish about. I don't care what their stock chart looks like. Their patents are expiring. Their research pipelines, they're running into so many setbacks, and that's why it's reflected in their numbers. I mean, their revenue, it decreased 5.9% year over year when you consider it quarter over quarter. 17.7 billion down to 16.6 billion. In contrast with Eli Lilly, it was double-digit growth. And Novo, it was also positive in the green. I think Pfizer, gosh, I really hate to say it because I know it's really popular in the dividend investing community. But as of right now, who they are, obviously things can change, a month from now, 3 months from now. They can invent a drug that makes you taller, right? Or a pill that makes your eyesight go to 20/20. Anything could happen, right? But as of right now, I do think they're a value trap. Because past 5 years, when we talk about 31% into the red for a company that did pump out a vaccine for COVID and all these other quote unquote exciting things, to be negative 31%? Dude, that's atrocious, no? I mean, hold on, let's back it up. Let's take a look at their performance, right? This is a free site, financecharts.com. And we're taking a look at the dividends paid out plus the share price appreciation. Will that put them into the green? No, you're still negative 12.5% into the red. Past 10 years, 31% into the green. What about 20 years? 200%, so you would have 3x your money in 20 years. But I just don't think that's acceptable. Because in the exact same time period, the S&P 500, past 20 years, was 10.6% year over year. Pfizer, 5.6%. With Eli Lilly, we're talking about just shy of 20%. Johnson & Johnson was almost the same as the S&P 500. Merck was 10%. Novo, 17%. So among their own peers, a 5.6% CAGR. And in the recent times, past 5 years, negative. So when you see negative 2%, what that's saying is that your money would have shrank by 2% year over year for the past 5 years. Past 3 years, it's horrific. Negative 14% year over year. So with Pfizer, I'm so sorry. I know this is juicy, but $1.72, the payout ratio is almost 100%. Do I see their dividend being sustainable? I don't think so. I mean, it's trending in the right direction, so it could be sustainable. But I wouldn't be surprised if the dividend stays flat at $1.72 or if it grows at a very tiny rate like it is right now, right? I think a better way to assess it would be the free cash flow per share, $1.82. So the payout ratio is closer to a 90, 91%, not 99%. But still, I mean, doesn't that make you kind of uncomfortable to know almost 100% of the profits that the company generates is allocated towards the dividend? Meaning, how are you funding the research and development? How are you funding to reinvest back into the business? You got to take on more loans. You got to issue more shares. So for me, I like Pfizer. Listen, I really don't like pharmaceuticals or investing into them. The idea of putting any of my money near them. But with Pfizer, it's absolutely a no. This is the definition of a value trap. You feel like you're getting a good deal because of this. But if you turn your eyes to their numbers and fundamentals, 14.9 billion is pretty much flat. No, it shrank over the past 10 years. You take a look at their fundamentals and stuff like that, it's kind of, yeah, guys, this is not it, right? This is not it. Let's take out their free cash flow real quick. Yeah, I mean, for your free cash flow to be declining in the past 10 years, it's says a lot, right? It says a lot. The ROIC will be the final straw here. 7%, not bad. Obviously, during the pandemic with their vaccine, it skyrocketed because they were just killing it, right? Crushing it. But there's no more need for it, right? I think COVID is of the past. I mean, I think it's still around, but I heard it now. It's kind of like a mild flu, something like that. It mutated to a variant where it's no longer like a zombie outbreak like it was in 2020, 2021. So, yeah, guys, I don't know what the catalyst is for Pfizer, because usually with these pharmaceuticals, they have like a one unicorn drug that's in the last stage of their clinical trials that's ready to go GTM. But with Pfizer, all I know is that their patents are expiring from their hit drugs, and I don't know of anything that's pending in the pipeline that's promising. So, not a fan. Not a fan. Now, obviously, I could be wrong, but it's just what I think. Let's do SoFi. This is a online bank that I did cover in the bank breakdown video. My takeaway from it was phenomenal. For a startup, I think they're just absolutely phenomenal. For the numbers that they're executing, it's just absolutely beautiful. The exponential growth of their top line year over year is just simply impressive. And up until 2024, they were unprofitable as a business, right? Now they're profitable. And apparently the people that use SoFi, they like it. Hold on, let me get a water break real quick. So the product and service itself is good. It has a growing community that sells itself. They don't really need to pump money into marketing because the happy customers, word of mouth, they tell their friends, and then lo and behold, there's more people switching over, right? Closing down their brick and mortar bank and jumping on over to SoFi. Balance sheet should be good. I mean, most banks have a phenomenal balance sheet because they're in the business of money, right? If your balance sheet is bad as a bank, you've got some problems, man. Yeah, $450 million of cash left over. Free cash flow should also be phenomenal. Ooh-wee! No, it's not. $3.1 billion into the red, but then I think I understand. It's probably because they're spending a crap ton of money right now scaling. Because SoFi, once again, is a startup. Not trying to give them excuses, but probably what's happening, right? They're probably investing a crap ton of money, trying to scale, trying to grow. I mean, there's $218 million into CapEx. Yeah, they're probably spending a lot of money trying to take away market share and trying to make an impact into the banking space that tends to be really fierce. Like the traditional banks, they are not friendly. They are hostile towards the startups. When we think about Wells Fargo, Bank of America, SunTrust, they do not want the startups to thrive. So I'm going to go ahead and assume that SoFi is probably using a lot of the free cash flow in order to operate at a loss in certain areas of their business so that they can take away customers. So like, let's say in traditional checking bank accounts, there's a fee baked in to whatever it is that you got to do. I'm sure SoFi eats those costs so that the customer stays satisfied and that it's their differentiator from the competition so that people hop on over to them. And to do that, you do got to lose money. But they are still profitable as a business on paper. But their free cash flow being negative, for me, that's one yellow flag. Take a look at their ROE, an 8.5%. I think that's pretty good. It's not too bad. I think with SoFi, even though they don't pay a dividend, this is a company that I would be willing to invest into, just not at their current valuation, especially with a PE of a 46. Honestly, if I had to, I'd probably just go with PayPal, right? I feel like their future is just as promising, but their valuation just makes no sense. Now, would I want to, though? I wouldn't want to invest into PayPal. If I had to invest into a fintech payment processing company, it would probably be XYZ. They're also near their 1-year low, and their valuation's also really low, but I feel a little bit more bullish. Why is this not working? But I feel a little bit more bullish about XYZ than I do with than I do with PayPal. And I think I talked about that in the buy now, pay later sector breakdown video. I just can't think of it on the top of my head. And another one would be this one, right? The fintech software company for all of the mom and pop restaurants and for some of the more chain-oriented ones as well. Super bullish on this one. Yeah, I think there's one more company that I wanted to talk about. Let me see. Yeah, that song has been on replay. I've been listening to that song nonstop, a couple minutes. Olivia Dean. Dude, that song is so good. Anyways, I think it was in this video. Let me see. I think, what was the comments? It was, why no love for Cal-Maine? So that's going to be the last one I want to cover. So Cal-Maine, I'm going to tell you right now, they're going to get their own dedicated deep dive video because I've been spending the past 2 days reading everything that I can about the egg laying industry in the US. So I'm going to give you a more proper breakdown of Cal-Maine. And I'm not going to give anything away. I'm just going to show you their numbers and let you formulate an opinion. So year to date, man, stock analysis is kind of lagging right now. I'm assuming there's a lot of people logging in or something. Year to date, negative 16%, 1 year out, 8% into the red, 5 years, 120%. Current trading multiple is a 3. No, I didn't stutter. No, you're not blind. It's a 3. Okay, so when you take their stock price, $86, and you divide it by their earnings per share of $26, you get a 3. Their forward trading multiple is 11. Okay, I'm not going to give any of my commentary. I'm just going to show you their numbers, okay? Their top line went up 65% year over year. Okay, $4.3 billion. Are they profitable? Well, yes, they are, because we just learned that their earnings per share is $20.64, which is the bottom line per share. Take a look at their balance sheet. Flush in cash, $1.2 billion. Okay, what about their total debt? Why is their total debt not showing? I guess they don't have any loans on the books. So $1.2 billion of cash left over after accounting for their non-existing loans. Cash flow, free cash flow is $1.2 billion of free cash flow. Take a look at their ROIC. 43%. Are you kidding me right now? The return on equity is 55%. Are you kidding me? So, Cal-Maine Foods, they're in the business of eggs and now also breakfast foods, such as waffles and pancakes. There's so much that I have to say when it comes to Cal-Maine. But you're going to have to wait for the dedicated deep dive video. Dividend yield is 9.7%, and it's a qualified dividend, meaning it's going to be taxed at the capital gains rate of 0, 15, 20%. Payout ratio is 33%. Dividend growth rate is 200. Dude, what is going... Is someone pranking me right now? Are you kidding me? And that's why I'm going to make a video talking about Cal-Maine, because it's not all rainbows and sunshines. And something else that I want to talk about is, hold on, let me see, S&P Fear and Greed Index. Let me pull this up before I sign out of here. So, if you've been watching your portfolio in the past like 72, 48 hours, dude, the stock market's been bleeding, okay? The Fear and Greed Index, what emotions driving the market? That means there were more sellers than buyers. Extreme fear. So, Thursday was at a 6. We haven't seen those numbers since the April 2025 sell-off and then the pandemic sell-off. So I don't know about you, but I used that opportunity to buy, okay? And, there's a whole different array of issues of why hedge funds and big money is selling out. It's probably AI profit-taking. They're seeing how the Mag 7, their return on investment is like 80%, 200% into the green. They're probably selling to see some of the gains. Sometimes people sell when it's towards the end of the year to capitalize on their losses and gains. I personally think it has more to do with the jobs data because it came in pretty hot, meaning the economy is doing better than expected, which means that's going to have a huge impact on the interest rate cuts that were supposed to happen, right? So now there's uncertainty baked in. So there's a lot of factors as to why the stock market is acting very fearful. But for me, I don't care if the times are good or bad. I'm always going to be buying. More importantly, buying when there's blood on the streets. A year ago, when things are 56 and operating in the, as it should, or if it's over here, extreme greed, I don't buy. I literally wait patiently on the sidelines. I put my money into a high yield savings account and I just wait it out. Now is the time where I buy. Okay? So I've been dollar cost averaging on my existing positions like Salesforce, Amazon, Clorox, Procter & Gamble. And I came so close to pulling the trigger on Meta, but I'm waiting. I'm waiting for the exact price that I want it to be at. That exact price is up on the Patreon. But what have you been doing? Have you been watching? Are you waiting on the sidelines? Have you been dollar cost averaging? Let me know. And especially about my hot take on all of the different stocks that we covered in today's video. Let me know. And other than that, let's talk about the baby, right? The baby about to hit 5 weeks. Absolutely crazy. Okay, I'm a first-time dad. I know my face it looks really young. I'm 35, okay? I'm in my mid-30s, first-time parent. It's been a lot harder than I anticipated. I knew it was going to be really hard, a challenge, but it's been really hard. And I think that's because I'm trying to make the dedicated effort to be an active dad, to help out a lot. I think if I was more hands-off, I don't think it would be as hard, but man, it's been really hard. And for the past couple weeks, the mother-in-law was here. And initially, we thought it was going to be really, really a positive variable, right? To have someone in the household help us out. But dude, that was probably the worst decision. Arguments left and right, the nagging, the you got to do it this way, not that way. It's just the amount of stress that was introduced. So I'm going to say this right now. If you have the option to say no to your mother-in-law coming over to help out with a newborn, say no every single time. Say no. It is not worth the peace being disrupted. Ever since we dropped it off at the airport, dude, there's been no more drama in the house. We're happier and we're more dependent on each other to get things done. And it's a lot better. Now, the bad thing is, now that she's gone, I can't allocate the precious little time that I had to YouTube as much anymore. So I'm like, oh man, but the crazy part is 1 month down, right? And I just have to say, I just really appreciate you guys for supporting me because I know I'm not stupid, right? There's so many different YouTube channels and people that you can choose to support or to watch or to comment on the videos, but you choose to do it with me, right? And I'm so freaking thankful, man. Truly, I feel so blessed to have you guys. So for Thanksgiving this year, you already know that I'm going to say I'm thankful for the Dividend Compounders with Cheese community. You guys are awesome. Now, with that said, I gotta go make a grocery run. So stay safe. Good luck in the stock market, and I will talk to you guys really soon. And let me know what you thought of this concept, okay? Yeah, peace out.